Thank you, Mr. Chairman. Dr. Ball, I'm going to take the unusual step of asking you some questions. I've learned not to get in a battle of wits when I'm woefully underarmed. It's been a long time since I've taken economics, so I'm going to ask a couple questions and try not to make too big of a fool of myself. But let me ask you this question to start off. Do you believe there is such thing as a tipping point in the size of this debt?
Oh, absolutely. And I think probably all three of us agree there is a tipping point, and we don't know where it is, and it would be prudent not to find out. So, you know, by no means do I want to say that we shouldn't be very concerned about long-run sustainability. And that's sort
of where I was hoping we could get. That I think one of the things that all three of you could agree on is that if we get past that point, it would be actually much worse than the situation we find ourselves in today. Is that a fair statement?
Probably. I think, again, because the U.S. is special and this is unprecedented, when it would happen or how bad it would be, it's the kind of thing we don't want to learn about.
And that's one of my frustrations with the classical Keynesians, is that they seem to lack, in my opinion, a long-term outlook. We're always looking quarter to quarter. We're looking year to year. There is no long-term, and you remember what Dr. Keynes's comment was regarding the long-term, and that we're all dead. We've sat in this room this year with a board of experts regarding entitlements, and I'm talking there were 2 Republican witnesses, an independent witness, and a Democrat witness, and the window of opportunity that broad group gave us to fix entitlements was someplace between 2 years for the most conservative and 5 years for the most progressive or liberal witnesses that we have. And one of my concerns is that when I read your analysis, when I read your testimony, is that we lack any type of mid to long-term outlook, that we're simply looking at the next quarter in a way in an effort to try and boost the GDP. You go to the end of your testimony, for example, you talk about why printing money, why expansionary policies might not have the same type of inflationary outcomes that we've seen, or that many of us, including many of the members of this board, and I know Mr. Edwards and Dr. Meltzer, fear, because you say that businesses generally do not monitor the Fed's balance sheet and they do not base their pricing decisions on changes in the monetary base. I used to run a business. I can assure you that I didn't watch the Fed Reserve and I didn't watch expansionary policies. But what I did watch was my costs. And that when my costs went up, I had to raise my prices. And I can assure you, while I wasn't watching the Fed, the brokers in food and fuel certainly were. And as my costs went up because of expansionary policies, I had no choice but to raise my prices or to go out of business. You go back to the Weimar Republic. You saw a tremendous inflation. In fact, hyperinflation without an overheated economy. It was driven entirely by the printing of money. There was high unemployment at that time. There was fairly low productivity. And what we had was, well, we had middling productivity, but you had tremendous inflation. And one of the things that I fear when I look at your proposals is that we are underestimating the risk of inflation and hyperinflation. Take a minute and tell me why I can sleep at night and I shouldn't be too worried about that.
Well, first of all, on the fiscal issues, you talked about the long run and the short run. I mean, I think the quote about in the long run we're all dead is something that people are a little bit embarrassed about now, because the long run is important. And again, I think there's a lot of agreement about the long run dangers of the debt. It's just we need to be realistic about, if we're very aggressive right now at cutting the debt, there will be major costs in the...
If we believed that we were closer to the tipping point rather than further, if we believe that we were closer than you think that we may be, let's say that we're the 2 years, you're the 5 years, isn't it entirely rational for us to be taking the steps that we are proposing?
Well, I think at some level the right steps are obvious. Maybe everybody could even agree. It's addressing the looming long, I mean, there's the CBO chart of the debt going off. That's because of primarily entitlement programs. So in a perfect world, Congress would get together and have a friendly discussion and figure out some nice moderate compromise on how to fix entitlement programs. And that would solve the long-term problem without giving a big negative jolt to the economy today. I mean, if we address the deficit just by willy-nilly spending cuts over the next decade, I mean, maybe I'm not going to say whether that's overall good or bad. But there's going to be higher unemployment. There are going to be costs, so we should be realistic about that.
You mentioned very quickly, I have just a few seconds, you mentioned willy-nilly cuts, and I agree with you. They're simply going in and cutting randomly might have a different output than coming in and cutting specifically. The Canada example is one that several of you have mentioned, and there, if you go back and you look at the history, it appears as if their cuts focused primarily on wealth transfer programs and not on infrastructure. Would you agree, sir, with me with the premise that cuts in wealth transfer programs might have less of an impact on employment than cuts to infrastructure spending?
I think that is plausible because infrastructure spending has a substantial effect on employment. Let me just say very briefly on the inflation issue. That's something where maybe I do differ from others, that I think the fears of inflation really are quite unwarranted. And that is a boogeyman that doesn't really, and again, without the long economic debate, I think historically in the U.S., inflation pressures have taken off when the economy is overheated. And unemployment has been low, so workers push for higher wage increases. Firms are straining their capacity, so they have more of an incentive to raise their prices. And an overheated economy is obviously the last thing we need to worry about right now.
Thank you, Doctor. Thank you, Mr. Chairman. Sorry to go over on time.
No, thank you.